Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we're here to talk a little bit about how the equity markets are reacting so far to what looks like is going to be another sizable stimulus bill for the US economy as a result of COVID-19. That has ramifications for both fixed income markets as well as equity markets. But so far, markets relatively calm, responding positively to this so far. We will get some more information later today at the Senate hearing. So let's go ahead and discuss a little bit about what our expectations are. Now, before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So as usual, we'll start off with our broader market update in terms of where the broad-based indices for equities are currently trading. We'll take a look at fixed income markets as well as commodity markets to see how they're currently reacting. The dollar certainly is at risk of further declines as we introduce large stimulus bills like the ones that are currently on the deck today. I want to review as far as how economic data is currently looking. We're starting to see a little bit more bifurcation between the production side of our economy and the consumption side of our economy with consumer spending and consumer confidence with manufacturing and industrial production, what that means for the recovery, and where should we look for opportunities within the equity markets. And to help better understand that, we're going to look at the full sector review after looking at the economic data. We'll share with you a couple of ideas, and at the end, if we have a few minutes, we'll open this up for Q&A. But the primary question that I want to help investors answer here today is really how will further stimulus, specifically the $1.9 trillion that is proposed by Biden here, how will that impact the equity and fixed income markets? So my name is Tony Zhang. I'm the chief strategist here at Options Play. And what I want to share with you are my technical analysis charts, my economic research, and the way that I'm currently viewing the current market conditions based on what we're currently seeing. So just to give you a sense for the current Biden stimulus plan that he wants to enact after the inauguration, it's roughly $1.9 trillion, which if you look on size is just a little bit larger than the $2.4 trillion, just a little bit smaller than the $2.4 trillion that the US government first responded to COVID-19 with, the $900 billion that was recently just passed right before Christmas, and now Biden is proposing another $1.9 trillion. Now, what impact will that have on the broader market? So Moody's did a little bit of analysis in terms of expectation back to full employment with and without this additional fiscal support. Without it, we're looking at closer to 2024, while Moody's is expecting with the new $1.9 trillion that would likely accelerate down to 2022, which obviously, depending on how you're looking at this, can certainly be a very net positive. Now, $1.9 trillion is by no means a small amount of money. This is actually what Chairman Yellen is going to have to talk to the Senate about today at 10 a.m. is how does the government pay for this, largely through further borrowing? What impact will that have on the fixed income markets, on the equity markets? That's exactly what we are hoping to find a little bit more here today. But if you look at the equity markets so far, early morning before the open, so far the S&P 500, the broad-based markets are responding actually positively to this. We've had a pullback to the 21-day moving average. This is exactly what we had talked about here over the past couple of weeks. So far bouncing off of that 21-day moving average. The money flow both on the daily and weekly charts still remaining positive. Momentum is not particularly overbought, so it has room here to grow to the upside. But we are going on quite a few weeks with not a single pullback below the 21-day moving average. So markets are a little bit on the complacent side. They certainly are stretched a little bit to the upside, but they're not overbought, but we are seeing some divergence here. So we need to be careful in terms of how we position for further long positions in the equity markets. If you look at looking at the NASDAQ 100, same thing, retesting 21-day moving average here. As you can see in a low volatility environment that we are in right now, those have largely corresponded with potential short-term buying opportunities here for holding periods that last a week or two. If you look at small caps, continue their strength here, as you can see, well above its 21-day moving average, nowhere close to pulling back to that 21-day moving average and starting to move higher as well on the IWM. And IWM on a weekly basis, fairly stretched here compared to its 200-day moving average, well above its 200-day moving average here, and continues that strength here. So IWM continue to push here to the upside. But the one thing I will point out for investors that are concerned about the rally we've seen in small caps, at least compared to the mega cap names, this is a chart of value versus growth. As you can see, value has been underperforming growth for a very long time, multiple years. As you saw here back in late 2018, value started to break out a little bit, but failed and continued to move lower. And the question is whether right now what we're seeing, if that is a rotation into value, because this is the base that has started to form here on the weekly chart here. If you zoom into that, this is what you get, what looks like an inverted head and shoulders, and it's starting to break out above its 200-day moving average. Now, it hasn't broke the neckline yet, so I don't think we're ready to call a full rotation out of growth into value, but we're right on that breakout potential, that neckline of this inverted head and shoulders. So this is what we brought up last week. This is what we'll continue to monitor here going forward, because that's going to help us determine whether we expect to see further IWM strength compared to the broad-based indices. If you look at the RSP, which is the equal weight S&P 500 index, this is the part of the market that continues to outperform. As you can see, not pulling back to that 21-day moving average, continuing to move higher here. This is showing us that there's broad-based rally here across the entire equity spectrum. It's not just a few mega cap technology names dragging the markets higher. It's actually the broad market catching up, if you will, to the trade that we have seen over the past year of equities continuing to rally during what is considered a fairly difficult time from an economic perspective. If you look at the VIX, VIX remains elevated, still trading at 22. And largely, if you think about the amount of uncertainty that we have right now versus the uncertainty that we had back in January, certainly, I would say that volatility remains fairly elevated compared to that. Certainly, there's no doubt that there's more uncertainty now, but is there twice the amount of uncertainty? And if you go out 3 months, if you look at the 3-month VIX, the 3-month VIX is still trading at 27%. This is telling us that investors are extremely concerned about potential pullbacks or just general volatility over the next 3 months or so. And that remains fairly elevated. And that's the primary difference between the complacency that we're starting to see in markets right now versus the complacency that we saw in markets in January of 2020 before the start of the coronavirus. Investors are cautious. Investors are not asleep at the wheel. They are anticipating further volatility here. Now, when we look at the dollar, this is really one aspect of the market that is likely going to have a huge impact from a big stimulus bill like the $1.9 trillion that the Biden administration is looking to pass. As you can see, the dollar index has weakened substantially since the beginning of COVID due to the large stimulus that the U.S. government has initiated with the large amount of Fed purchasing in order for it to pay for that. And we've recently had a bit of a strong rally here in the dollar here over the past couple of weeks. Past couple of weeks. I can't help but feel that this is another entry point for a further move to the downside, as we've seen here prior in the past. Moves above the 21-day moving average have become shorting opportunities, and that's exactly what I'm expecting here for the US dollar. Now, again, that has ramifications for assets that are denominated in US dollars and fixed income products. So this is really where we turn to some of the commodities. We take a look at everything from Bitcoin to emerging markets to gold and silver. These are all things that are priced in dollars and have some ramification here. Gold declining quite a bit here over this past couple of weeks that we saw the dollar rally under. This is one of the first times we've seen gold pull back below the 200-day moving average. The last time we had this was in late November. That was a buying opportunity here. And this is largely what I'm expecting here as well, is gold currently trading within a bit of a range here. And the fact that it's at the bottom of the range, at least for me, provides more opportunities to buy rather than sell despite the break below the 200-day moving average. And when we look at crude, crude continues to actually surprise us here to the upside, but crude is against this fairly major resistance level, which is 53. As you can see, it provided support for a long time and is now back up to the $53 resistance level, which happens to be the 200-week moving average here. So you have some pretty sizable resistance here to the upside. I do think that there's a possibility for this to break out here to the upside, but I do think breakouts will be somewhat limited in terms of scope up to about the $68 resistance level, which was the prior resistance that we saw before the coronavirus. So back into this 52, 58 range here is likely what we may see crude move to, especially as we see this decline here in the US dollar. Now, if we look at economics, this is really where we start to see this bifurcation, because consumer spending has really been what has driven the economic recovery that we have seen over the past 6 or 7 months. But what we're starting to see surprise here to the upside is industrial production. Industrial production and manufacturing here in the US has actually continued to surprise here to the upside, 1.6% versus the 0.5% expected from industrial production. Manufacturing up almost 1% versus the survey expectation of 0.5% here. This is month over month growth in terms of industrial production. So both manufacturing and industrial continue to expand. So as manufacturing, as we see some onshoring or reshoring, if you will, of manufacturing and industrial production, this is actually one segment of the markets that we really need to pay attention to, specifically from a sector perspective during the economic recovery, and vice versa. On the other hand, what we're starting to see here is retail sales decline here to the downside. Retail sales coming down here in the month of December, a decline of 2.1% versus the survey expectation of only a contraction of just shy of 0.5% here. So consumer confidence and retail sales starting to deteriorate, starting to moderate here to the downside. We do expect stimulus to bring this back up a little bit as well, but this is one of the things that we want to pay attention to here, is this kind of bifurcation that we're starting to see between consumer spending and manufacturing and industrial production. So what I want to do today is take a look at the broad-based sectors and take a look at how they're performing, which ones are outperforming, which ones are underperforming. So as you're positioning for the equity markets, or as you're positioning within the equity markets, you have a sense for which sectors are strengthening, which sectors are weakening. So as we said before, the manufacturing and industrial production have been extremely strong on the economic front. So these are two segments of the markets, or sectors of the market, that remains fairly resilient. This is XLB Materials. Materials recently breaking above the $73 resistance level, coming to retest this 21-day support here just yesterday on Friday. And I believe that this is a base that you can start looking for a continuation higher here from materials. As you can see, both the weekly and daily chart have extremely strong money flow. Both have pulled back here into the what I would consider more neutral or bullish territory from a momentum perspective, and has the opportunity of continuing higher here. So we see that for materials, which looks a little stronger than industrials. Industrials have not broken out yet, but as you can see, so far forming a base here between 86 and 90 here, pulling back to the 21-day moving average, but largely breaking out above those February all-time highs. So industrial production, or industrials, also looking fairly strong here, setting up for a potential breakout here. Both daily and weekly money flow are positive, not as strong as materials, but momentum provides quite a bit of upside here for continuation higher here on industrials. When we look at communications, this is one of the sectors that has been extremely strong off of the March lows and fell back a little bit and then started to continue again as the surge of coronavirus cases came back later towards the end of the year. But we're starting to see this slow down a little bit again here. So this is the September 2nd high that we put in here for XLC. As you can see, communications, even despite breaking above that at the end of last year, at the end of November, has largely failed to continue that strength and is starting to weaken and potentially break down below this. So this is really where we're starting to see that strength rotate out of communications. And this makes sense as we get back into a recovery. There's going to be slightly less demand for a lot of the streaming services and gaming stocks that rally during the lockdown periods, if you will. Perhaps as consumers start to get back to work in offices, the demand for broadband and home might deteriorate a little bit here as well. So we're just starting to see the rotation out of communications as a result of this, but we're still at a fairly key level here. I would pay attention to this level. If we do bounce and break higher, then I would continue to look for strength here in communications, but it is on the verge, in my opinion, of starting to slow down. As you can see, money flow here on the daily chart starting to dip down into that lower period, momentum starting to also slow down here as well. So be careful on XLC or communication type stocks. If you look at real estate, one of the worst performing sectors here in the broader markets, showing a little bit of strength here towards the end of last week, but largely, in my opinion, this downtrend still intact here. I wouldn't be surprised if you do see some rallies here from XLRE. Some of the rent numbers and housing numbers came back relatively strong last week. And so for now, real estate, still one of the weakest sectors, but perhaps showing a little bit of strength here. But largely, I would expect real estate to be more range bound rather than seeing any strength and actually rotation into real estate per se. I just don't see the fundamental thesis or the technical thesis for why real estate will start to rally here. If we look at consumer discretionary, this is the segment of the market that still remains extremely strong. Really slowed down the momentum here over the past couple of months here, but started to accelerate here a couple of weeks ago. We're starting to see potential further upside here. The daily money flow, weekly money flow still remains fairly strong and positive. Recent pullback and momentum provides a little bit more room here to grow here to the upside. So we're no longer overbought here on consumer discretionary. So out of the consumer names, discretionary still remains by far the strongest. If we look at consumer staples, we'll start to see that we're starting to see staples slow down here. But financials, this is the big breakout here over the past couple of months is financials. Financials have largely underperformed the broader markets up until the Pfizer vaccine, which really accelerated financials here to the upside. We have seen a substantial move in terms of 10-year yields. 10-year yields are still now above or hovering above 110 basis points. We have a steepening rate curve. We have a fiscal stimulus coming in, a potentially large fiscal stimulus coming in, which will largely provide support here for the banks. And this is really where XLF has further upside potential here. As you can see, money flow on the weekly chart turning positive here over the past few weeks. Money flow on the daily chart remaining fairly positive. We did recently pull back below the overbought conditions and likely have the possibility of further upside here. And we do have this major double top potential here on the weekly chart. These are the February 2020 highs prior to the pandemic. We're just on the verge of a potential breakout here. If we do get that breakout, that's really what provides a lot of the upside potential here for XLF. XLP, consumer staples. This is the other side of the consumer names that we were referring to. As you can see, consumer staples failing largely to break out above those September 2nd highs. Every attempt to break above it has largely failed. We started to come down below this. We started to make lower lows here and starting to break down here. This is the chart that, very similar to XLC communications that we're starting to see. money flow, as you can see on the daily chart, has been declining here over the past few weeks and starting to turn negative here. The weekly money flow still remains positive here, but as you can see, momentum starting to slow down here on both the weekly and daily charts here. So XLP, consumer staples, at risk of a further pullback here, especially if equities momentum starts to slow down here. So XLP, we're starting to see the rotation out of XLP into some of the other names. An interesting sector that is continuing to show a little bit of basing here is utilities. Basing here above the $61 range here. Now, utilities largely, we don't expect to be a big performer here. So upside here, you have some resistance here in the $65 range, support here in the $60 range here, or right smack in the middle. I do see that we could see a little bit of strength here in XLU, but largely similar to real estate. My expectations for XLU is more range bound rather than further strength here, especially in a rising interest rate environment. XLU, which from a yield perspective generates about 3.1% yield, is certainly much higher than the rest of the sectors with the exception of energy. But I would expect that XLU would become less attractive from a yields perspective as treasury yield starts to climb here. The more treasury yields climb, the less attractive XLU's yield becomes. So that's really why we expect XLU, while showing a little bit of strength, is largely going to be capped as a result of the strength that we're starting to see here from treasury yields. Now, healthcare, this has been an interesting rotation because healthcare, we've seen multiple rotations in and out of healthcare. Off of the March lows, the strongest sector. Since April, late April or so, pretty much until late November, has largely underperformed the broader markets, meaning as the equity markets are moving 20, 30% higher, healthcare was only moving 10 to 15% move higher. But we started to see healthcare kind of keep up a little bit here, or actually break out a little bit here over the past couple of weeks. Healthcare, 114 was a major resistance level, recently breaking out above that level, coming back to retest this level as support, and has the potential now to continue higher. As you can see, the daily money flow, extremely strong, stronger than what we have seen here over the past 6 or 7 months, and the momentum pulling back to below the support level, or back below the overbought levels, continuing to have room to the upside here. So healthcare, surprising sector to pay attention to that has seen some new relative strength here over the past couple of weeks. Another surprising one to pay attention to here is technology. As you can see, technology, these are the September 2nd highs. As you can see, technology, after trying to break out multiple times above these levels, so far has not really been able to sustain that. As you can see, money flow on the weekly and daily chart so far looking relatively weak compared to the other sectors, at risk of a pullback here. Now, what's the catalyst that could drive something like this? Perhaps a democratic government, a democratic sweep of both the House and the Senate. Perhaps investors concerned about anti-monopoly or or trying to break up some of these big tech companies. That could be weighing on this relative strength here that we're starting to see technology lose strength on. The fact that it's now below those September 2nd highs here is a little bit concerning to me, that it cannot keep up with the broader markets and rally here. So technology, surprising strength here that we've seen in the markets over the past few years, starting to lose that relative strength here. Not broken the support level yet, but on that verge. So be very careful here for technology as you're positioning for the continued upside here. Where do you position for technology is certainly one that is at risk here. And lastly, energy. If you look at energy surprising us to the upside here, breaking out new relative highs here on the move that we started to see here in crude. I still think that $46, $47 here to the upside is some limit that we might see here on energy. If we break back above 47, that certainly puts us back into the 52, 53 range here to the upside. But from my perspective, I think the upside here is somewhat limited here for XLE. So look, that gives you a sense for the broader sector review and where we currently sit. There are some opportunities here, especially as we see some sector rotation into healthcare, into materials and industrials, out of communications, out of technology, out of consumer staples. That type of market sector rotation that we're seeing, that's healthy for a market to continue to rally here. We need to see that type of sector rotation, especially from very strong sectors out of those strong sectors into some of the weaker sectors. That is the lifeblood of a market rally here. So to see this type of sector rotation, that is encouraging for us to continue to position for a long here in the equity markets. So because we did a full sector review, just a couple of ideas here for today. Number one, transports. This is not the sexiest part of the markets, but railways, transports have been extremely strong. They're also on earnings on deck this week. Union Pacific reports earnings here later this week, recently breaking out above its 210 resistance level, coming back to retest this level as support. I think that is the potential catalyst on earnings that it needs to propel itself higher here above that level. As you can see, money flow starting to be strong on the daily and weekly chart, pulling back here with potential upside here. So if you're looking for earnings, we're early in the season. Banks have reported so far, but railways and transports is one of the less sexy, but really strengthening, strong parts of our economic recovery here at the very moment. The other one is on the semiconductor side. Texas Instruments continues to build the chips for a lot of the consumer electronics that consumers have continued to purchase here. Texas Instruments also recently breaking out above its all-time high around 165 here. Breakout here, came back to retest this level as support, potential opportunity for a continuation higher here. Both daily and weekly money flow remains fairly strong here. Pull back here and momentum provides that potential upside here. So that covers, for me, what I wanted to discuss with you here today, which is largely on the back of, we have a large stimulus bill that is in the pipeline here, and just Chairman Yellen is going to be in front of the Senate today at 10 a.m. to discuss that. You know, that's going to again have ramification on fixed income markets, on equity markets. But if you look at how equity markets and fixed income markets are reacting so far, we haven't seen some big reactions, which is good. Equity markets so far responding fairly positively. Fixed income markets have not moved very much either, which also speaks to more stabilization from the fixed income markets. So for those reasons, we remain cautiously bullish on the equity markets. The sector rotation we're starting to see is very healthy for the current market rally. Just be careful in terms of positioning because we are fairly complacent. So keep your long positions light. Be nimble in this current markets because the short-term pullbacks here can materialize fairly quickly and kind of out of thin air, if you will. So be careful in terms of how you position for this overall market. With that, thank you so much. I hope that this helps you start off your trading week here, and I will see you guys here later this week on our next options education session, which is tomorrow afternoon. So thank you so much. I hope you have a great trading day, and I'll see you guys here tomorrow evening.